Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. It is Stampede Week. All this week we are focused on commodities. Don't forget our next episode is going to be with Adam Waterous, who's in hot pursuit of Meg Energy. So mark your calendars for that episode. But today I spoke with Bob Thompson, and he's known as a commodity investor, and he says we're on the cusp of another major cycle of outperformance. And I'll be honest, I know I do a lot of commodity shows, but I don't really think I'm a good commodity investor, so I tend to avoid this sector. Now, if you're the same, this episode is for you. It's for the investor who's done nothing but invest in US or tech stocks for the last little while. And for me, it was a bit of a wake-up call, and I'd love to know if it was for you. Leave a comment wherever you're listening. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO Investor Line. Ready to take your trading to the next level? For those interested in the dynamic world of options, BMO Investor Line provides a robust self-directed platform. Get access to sophisticated tools that can help you identify potential opportunities, analyze risk, and implement your option strategies. From intuitive strategy selection tools to detailed market data, BMO Investor Line equips you with the necessary resources to navigate the complexities of options trading. Start now at bmo.com/investorline. Bob Thompson, thank you so much for joining me on the show.
Great to be on the show, Amber. I've been looking forward to it for a while.
Well, I'm so lucky to be with you at a time when there's a big question mark in the markets about what is the next stage of outperformance look like. And right now there's such a debate. Is it going to look like what the last 10 years have looked like, where it's US dominance and it's tech stocks, or are commodities going to finally have a cycle that lasts longer than a couple of months? And your focus, you're a money manager, but your focus is the commodity space.
Right. I'm a generalist, so we can buy anything for anybody, but we actually are focused quite a bit on the commodity space right now because I think that's going to be the place to be for the next decade. And I've been in the market for 30 years, not as long as Ross Healy. I think it was 50 years when you talked to him, but I've seen this happen over and over again, and I think we're due for a big cycle. So we're pretty focused on that area right now.
Okay, so this is really interesting. And Ross, I thought it was 50. It was actually 60 years, if you can believe that. So he'd seen many a cycle. You've seen many a cycle. And I know, millennials, which I am, they get a bad rep because all we've ever seen is really a bull market driven by one type of asset. So I want to take a step back and understand the why. Why do you think the setup for commodities looks good right now?
Well, the fact is the commodities always have to come back, and that's the great thing. It's probably the most cyclical sector of any sector, but they have to come back. And the reason is because, I say to people, look around the room, wherever you are, every single thing in the room has come from above ground or below ground, right? It's trees, it's been mined. And as the world grows, we have to replenish that. And the thing about mining, oil and gas, or anything else in the commodity space, is it's a depleting asset. Once you take it out of the ground and use it, you don't have it anymore. So you got to go find some more of it. So that's why these cycles are so predictable, and they happen every, it's interesting, every 15, 16 years. Plus or minus a couple of years on each side, you get these massive commodity cycles. And the commodity cycle is inverse to a stock market cycle, interesting enough. And if you go back decades and decades and decades, you'll see this happen. And why is that the case, right? If commodity prices are doing very well, then the general market is not going to do very well. And the reason for that is, let's say you're Kellogg's cereal and you have to go buy grain, right, and commodities to make your cereal. Well, as commodity prices go up, your cost inputs are going up and you can't pass all of that on to the consumer. So your profits get squeezed. So it makes sense that as commodity prices go up, stock markets and general companies don't do as well. And I think that's the environment we're in right now. But we're in a stealth commodity bull market right now. Nobody knows it yet, but we can go over some of the numbers as to what's happened in the last couple of years already.
Yeah, elaborate that. Why are we in a stealth commodity bull market?
Because commodities have already outperformed the stock market dramatically in the last 3 years, and nobody knows about it.
Because of gold? Because of gold primarily?
Well, gold, gold primarily, and gold is first out of the gate, always. That's right. And why is gold first out of the gate? Because real rates tend to get squeezed. I mean, this time has been a little bit different because central banks have been buying. So most Western investors have missed this entire bull run in gold, but gold outperformed the S&P over the last 3 years, and actually over the last 5 years too, which is pretty incredible. And the stocks have started to come up now.
I guess, gold, we could talk about the different reasons why it has outperformed. Those consolidating right now. I'm still trying to understand the why of it. Like, what are the things floating around right now that you see as supportive for commodities to, outperform, not just over the last couple of years, but now for the next 5-10 years, because that's how long these cycles historically last?
Two or three reasons. One is relative valuations. So the valuations of the commodity and the commodity stocks are extremely low compared to history. The valuation of the S&P 500 is in the top 2 or 3% of its valuation highs throughout history. Second thing is, though, which I think is really important, is that during these kind of capital expenditure cycles for the market in general, and AI has been kind of the last bit of this here, no money is getting allocated to commodities, right? And because it's a depleting asset, and it takes, it used to take 10 years to get a mine into production after discovery. Now it takes almost 20, which is craziness on the permitting side. But no money's been put into the sector, so we're going to get this squeeze where copper, silver, potash, whatever the case is, the demand's still there. The demand's picking up, and we don't even have to get a big increase in demand. It's just the supply has been constrained so much that the prices are going to have to react to that. And I think that's the big reason, is because we've had, since 2011, we've had 10 or 12 years of really no capex going into the sector, and we've had no real big discoveries. And so, they say that the solution to high commodity prices is high commodity prices, right? And the solution to low commodity prices is low commodity prices. So what that means is that prices can only be this low for so long, and then they have to spike up. And I think we're right on the cusp.
I have to confess something, Bob. I'm not a good commodity investor, and because I'm not a good commodity investor, I'm not interested in investing in commodities, because I find it so difficult to, even if I find a good company, they're at the whims of a commodity price that I just find difficult to predict. Gold bulls have been saying the same thing about gold all the time, right? Those are the perma bulls, and I know that you're not a perma bull, but they make the same arguments the same time. And then it just happens, sometimes investors are paying attention to that argument, and sometimes they're not. So, and you know this probably better than I do, there are whole swaths of portfolio managers just put commodities away in a box and feel the way that I do, that it's just sort of this sector that is really tricky to invest. Let's go back to Kellogg's, there's some commodity inputs, but at the end of the day, it's just like marketing and putting out a good product, and there's a lot that's in your control.
Right. And if you had invested in the commodity sector 50 years ago, you'd probably be around the same level now as you were at that time, right? Because it's so cyclical. But the fact is that when the bull market happens, it's so incredible, the gains, that you have to understand it. You have to go with the bull market and then take those profits and redeploy them at some time, because it's so cyclical. And I did a book years ago, and Eric Sprott was in the book, and I asked Eric. He ran the Sprott managed accounts for many years, and didn't invest a lot in commodities. He owned 10% of Taser at one point and growth stocks. But around 2000, He became a gold and silver bull, obviously. But I asked him, I said, what do you like about the mining sector? And I think this pertains to your question here. He said, there's no other sector in the world where the highs are so high and the lows are so low that the difference between the highs and the lows is 10 times. He said, there's no other sector in the world like that. And if you can somehow get somewhere near the bottom, it doesn't even have to be right at the bottom, and somewhere near the top, he said, your gains are immense. And I think that's what we're coming up with in the commodity space right now.
I know, and the so lows I think burn in people's minds, right? And they penalize the whole stock. I mean, I was just looking at Bombardier, which oh my God, people are so bruised in Bombardier. In the last 5 years, it's up 1,000%. But I still don't think it's a core holding because people's memories are long and they know how badly something turned out. And to that point, let's talk about these stocks. Well, fine, say you do get a good cycle in oil or gold. You know this with your 30 years of experience. You can have companies that absolutely squander it. Talk to me about the class of companies today that you can invest in on the heels of a commodity bull market and how they're maybe different than they were.
Right. It's a balance. You have to understand it's a cyclical area. But you can't buy and hold forever. But when you're in a cyclical bull, I always say the portfolio is like a bar of soap. The more you touch it, the smaller it gets, right? So you got to ride it for the bull as much as you can. Pertaining to your question about the individual stocks, that's right. Mining sector is a really crummy sector, actually, right? Because there's a lot of things outside of your control, right? The mine might collapse, the mine might flood, the commodity prices might do poorly. That's why it requires good management. You need good management. Good management teams tend to be able to put their head down, fight through all that, and make a good project work. So I think good management's important, but and that's the reason I talk a lot about funds in the mining sector is because you have to be well diversified. I mean, 3 or 4 of your picks might be, a few 100% they go up. 3 or 4 might do nothing, and 3 or 4 go to zero. Right. But the way that works is because mathematically, you can only lose 100% on an investment, but you can make 10,000%. Right. So 3 or 4 of your names out of the 10 might be all of your returns. And that's why it's important in the mining sector to capitalize, I think, on that volatility and be diversified to a point.
In your pro picks, you're going to talk about some of your favorite managers in the space. So stay tuned for that. But I wanted to stay a little bit on the macro front. So entering a new commodity bull market, a new cycle, I wonder how much of that is underpinned by U.S. dollar weakness, which we've seen. The U.S. dollar is trading around the lowest level since March 2022. Here too, big debate. Is the U.S. dollar going to go back up, or does it continue to lag and underperform for years?
I'm glad you brought that up because I've often said that in order to get the macro picture right for the next decade, right, there's one magical call that you have to make. That's it. If you make this call correct, you will get the macro picture correct for the next 10 years. And that call is the US dollar, right? So DXY, right, which it's not Canadians, a lot of things, the Canadian dollar is going to go up or the US dollar. It doesn't matter what the Canadian dollar does. We're talking against a basket of currencies. Right. So the Canadian dollar might go down, but the US dollar goes down more compared to other currencies. Right. So it's the euro, it's the yen, it's the Chinese yuan, et cetera. So the US dollar peaked in around 2000 at 120. The DXY was 120. So we had a double peak actually in 2022 of about 115. Right. So it's pretty close to a double peak. And then it's been going down since then. So when the US dollar is in a bear market, it tends to do it for a decade, right? And when it's in a bull market, it tends to do it for a decade. So everybody was celebrating in Canada in 2011 or around that time when the Canadian dollar was 107 to the US dollar. Who wanted to talk about American investments at that time? All we wanted to talk about was commodities and oil and how great Canada was doing. Well, that was exactly the wrong time because it's been a bull market for the U.S. since then. Now, who wants to talk about the fact that Canada is probably going to do better than the U.S. stock market over the next decade? Here's a fun fact. In 2007, the TSX and the Dow were the same level. They were around 14,000. In 2011, the TSX was 20% higher than the Dow. The Dow was only 11. The TSX was 13. But you couldn't get anybody at that time to talk about the fact that U.S. stocks were going to outperform over the next decade. Right? Today, you can't get anybody to talk about the fact that the U.S. is going to underperform compared to the U.S. The U.S. is going to underperform compared to Canada. So I think that's the key, and that's the reason I look at ratio charts a lot is you get reversion to the mean. When you get things that are 2 standard deviations outside of the norm, right? There's a really good chance that it's going to revert back to the mean, and that's what we have right now. Commodity prices compared to the S&P 500 are the lowest almost they've ever been, but they're double bottoming with where they were in 1999 and 2000 and in the 70s before that.
So the biggest pushback I hear to that argument is just look at the 10 best companies in America and compare that to the 10 best anywhere. And with the US market so dominated by tech stocks on the cusp of what seems like an AI revolution, that's the argument. Are you going to buy companies that, pick rocks out of the ground? Don't hate me, gold bucks, but that's what it is.
No, of course. No, I love this question.
Or companies that are on the forefront of pushing like the next wave of an industrial revolution.
So this is where history repeats itself. It doesn't repeat itself, but it rhymes. So let's go back. Ross would remember this. I wasn't born at this time, but the Nifty 50 stocks in the late 60s. Technology was dominating. The big companies, Polaroid, Kodak at the time, they were market dominant. The technology was incredible what they were doing, and the valuations were extreme. So from 1966 to 1982, at the peak of that kind of technology revolution, the S&P 500 did nothing for 16 years. From 66 to 82, it was flat. And we had this massive commodity, revolution at the time, the 70s with inflation, et cetera. So things weren't different. Then we come up to 1999, 2000, and the internet changed the world. It really did. Right? I lived through that. I lived through the stocks going up 50 times and things like that in this 1999, 2000. So it was different that time. The internet was going to change the world. For the next 13 years, from 2000 to 2013, the S&P 500 was flat. It didn't go up at all for 13 years. And we had this massive commodity run. Today, AI is going to change the world. It's a different story. And commodities, anything not related to AI is never going to perform again because we have a new paradigm. So I think AI is going to change the world, but I think people are paying way too much. And I'll give you another few examples. When, it's interesting kind of having hands-on to talking to individual clients because, during these sort of bubbles, at the beginning, people come to you and say, what are your best AI ideas, for example? And, you give them a few names or whatever the case is. Then near the end of the bubble, they don't want to hear your best ideas. They want to tell you what their best ideas are because these are the things you should be buying. So case in point, back in 2021, the electric vehicle revolution is going to change the world. Nobody's ever going to drive gasoline cars anymore. It's only going to be electric vehicles. So had somebody call me and say, Bob, my 18-year-old is a great stock picker. I appreciate what you're doing, but he's a great stock picker. He knows what he's doing, and he wants to buy the next Tesla. And this is going to be the next. This company is going to go up 10 times from here. I said, okay, what's that company called? So bought a 1 or 2% position in the portfolio. Well, that stock from peak EV in 2021 is down 97% now.
Is it Rivian?
It was the other one, Lucid.
Lucid,
Yes.
yeah, that was my second guess.
And then there was Beyond Meat.
Oh God.
Right? There was the cannabis. There was the 3D printing. There was all of these things just in the last 10 years where the stocks are down 95%. I'm not saying that AI is not going to work. The thesis is absolutely correct about AI. Absolutely correct. So was the internet thesis. The only problem was in the internet bubble, you called the thesis correctly, but what happened is you lost 90% of your money, pretty much.
It's funny you mentioned, Bob, kids calling their parents and telling them what to invest in, because I can't help but think that a lot of kids are probably talking to their parents about Bitcoin and investing in crypto. And I'm curious what you think about that, because people talk about Bitcoin as like digital gold.
Sure, the gold story and Bitcoin story are the same story. And there's been a lot of, old guys in the industry that were kind of anti-Bitcoin, and now they're saying, well, Bitcoin will probably do all right because it's that whole gold story. I tend to, think if you want to preserve your capital and you want a currency alternative, I think gold's a little bit better. But anyway, the argument can be made for Bitcoin, but the Bitcoin industry has been great at marketing, right? They've marketed things a lot better. I think if the gold industry got out there and said, gold is an alternative asset, gold's going to preserve its value. Gold, how many people know that gold has outperformed the S&P 500 since the year 2000? Even in a bear market for a long time. Well, actually, it wasn't a bear market. Gold was going up. Gold's only gone down 2 or 3 years. The stocks, people weren't willing to invest in the stocks, but that's reflected in I think the TSX Venture. That's we can talk about this in a minute, but that's something I really want to dig into because nobody pays any attention to the TSX Venture anymore. And I think if you look at that, you can see an amazing upside with as money starts flowing into this sector.
Just because there's so much risk around the TSX Venture, how do you approach de-risking looking at the TSX Venture? Because you're absolutely right. Like if a commodity is moving well, a large cap will capture that, but a small cap you can like 10x or 20x your money, but at the same time you could lose it just as fast.
That's why I believe in employing some really good quality money managers because they'll dive into some of those stocks. There might only be 20% of the stocks worth investing in the TSX Venture, but when it runs, it runs big. And I just want to go over something here because in a world where everything's trading at all-time highs, gold's at all-time highs, the U.S. market obviously is at all-time highs, even the TSX is at all-time highs. The TSX Venture in 2007 was 3,200 on the index, 3,200. Then we had 2008 happen and it went down a lot. Then it peaked about 2,400 again in 2011, the TSX Venture. Today, it's 730. It's down 70%. So simple mathematics, if something's down 70%, in order to get back to your high, you have to go up over 300%. I'm not saying it's even going to go back to the high. It doesn't even have to go back to the high. But the upside is pretty immense, I think. And I'm a long-term investor, but I also understand kind of the technicals on the short side. We had a magical day on April 24th, 2024, and the TSX Venture broke through its resistance, pretty strong resistance at 640. And since then, it's gone from 640 to 730. So one of the keys in investing is things don't have to get a lot better to make a lot of money. They just have to stop getting worse, right? So it was so bad in the TSX Venture, the volumes were so bad that all of the volumes have to do is pick up a little bit and the stocks are up 50%. And that's what's starting to happen.
I wonder too, is the AI trade a commodity trade as well? If you think about all the energy and infrastructure that needs to support it. We've seen that show up. You've seen it show up in utility stocks. You've seen it show up in uranium. But because you do believe AI is going to be as significant as people predict it's going to be, are you looking for ways that shows up in commodities?
As I said, I'm a huge believer in AI. I'm just not necessarily a huge believer in investing in AI. right? So the second derivative approach is commodities, absolutely. I mean, and with Bitcoin, I mean, there's so much electricity required to mine Bitcoin. It's craziness. So oil and gas, natural gas, uranium, and every other energy source I think is going to do extremely well. And why again? Because there's been a huge underinvestment in the sector, even for oil and gas. I mean, I went to a board meeting the other day for a small pension fund, and the first thing they said is, we make it a policy never to invest in an oil and gas stock. And I thought that's wonderful. It's so hated. The valuations are so undervalued. I think there's huge room for upside in those sectors, because in all these years of actually trying to avoid oil and gas sector, we haven't reduced our reliance upon oil and gas at all.
Let's talk about that. The fact that a pension fund said that to you, because that does seem to be what's happening. And if you look at even all the M&A, and I know we'll get into it, it's all made in Canada solutions. It's all operators, right? It seems like these big funds are not coming back to the sector. Like, why is that pension fund staying away?
Well, they'll only stay away for so long because pension funds and most money managers, and that's why I think most money managers are not worth investing in. We can get into that too. It's a big statement, but 20% of money managers provide 80% of the alpha. That's always the case. Is because they're too concerned with their benchmark, right? So they're looking at their benchmark, and as long as oil and gas and gold don't outperform, they'll be out of the sector. What do they care, right? But when the TSX is up 15% and they're up zero because they don't have any oil and gas or they don't have any mining, they'll start to get into that sector, or they'll get fired. Because my industry is all about risk and reward, right? If you think outside the box and you do something completely different than everybody else, and you're right, you get a pat on the back. If you're wrong, you get fired. So risk outweighs reward. So they're all going to try to huddle around the benchmark. And here's a case in point. There was a lot of very, very, very smart people, money managers in the US in the last 2 or 3 years, that said, I don't believe in NVIDIA. I don't believe the valuation of NVIDIA. I don't believe it should be the biggest company in the world, et cetera, et cetera, et cetera. So they stayed out of the sector. Well, guess what happened? They almost got fired because they underperformed their index dramatically. So what happened last year is you saw this rush, and people said, okay, I got to at least get market weight of NVIDIA. And I have a friend in the US as a resource manager, and he went out with a buddy of his who's a generalist. And he said that the generalist manager during the whole coffee meeting was simply looking at his phone the whole time. And the guy said, why are you looking at your phone? Why? And he said, because this NVIDIA thing, I got to get in. I'm waiting for a pullback. But it's not pulling back. And if it doesn't pull back, I've got to get in because I'm underperforming my benchmark. So guess what happened? They all got their market weight in NVIDIA, and that was the top.
Yeah.
Right. And that's going to be the case with every sector. So here we are. The TSX has done okay this year. A lot of the gain has been gold stocks because gold stocks are up 50% on the year. I can bet you that the average TSX generalist manager has a severe underweight in gold, which means they severely underperform the index. And they're all so in this consolidation. Interesting enough, for gold in the last 2 or 3 months, the stocks have been increasing. The stocks have continued to go up, and that tells you that people are got to get into this sector because they're underperforming. So I think that's the key, is that a lot of it depends upon flows, and it as you said, here's another case in point. I think this is really important to cover, Amber. There's only been one sector in the world that has been as hated as the oil and gas sector. And we'll cover which sector that is. So this other sector was under extreme political pressure, extreme pressure from taxation, increased taxation on the sector, and extreme social pressure.
I'm trying to
killing
guess.
People.
Cigarettes, tobacco.
So tobacco in the 80s was the same thing as the oil and gas. Political, social, taxation. right? Taxing increased profits. Well, guess what? From the mid 80s till they were taken out over the next 20 years, the best performing stock on the TSX during that time was Rothmans. And Rothmans paid a huge dividend. They had huge stock buybacks, and they also paid out massive special dividends. That was the best performing stock on the TSX. It was the most hated sector. So what are the oil and gas companies doing now? Chevron bought back $78 billion worth of stock. They're not reinvesting in their businesses. They're buying back stock. They're paying out special dividends. They're not allowed to reinvest back in their businesses. So that's why I'm so positive long-term on oil and gas stocks. Not in the short run. I mean, we've got lots of things going on in the short run, but I'm talking kind of medium to longer term. And if you can pick times when it's especially hated, which right now, oil and gas stocks are more hated than they were in the COVID collapse.
This is so great. I want to pause here because we've got a bunch of questions in the mailbag about oil and gas and the energy sector. Let's get into it. All right. Our first question in the mailbag is from our friends at Bullish Trend on X. They're very excited to have you on the show, Bob, as am I. The question is about what sector are you slowly building positions in? Usually Bob is great at picking up a sector before a big move up. So you've talked broadly about commodities, but is there a sneaky sector that you like right now?
Sure. Let's talk about that. Gold's always the first out of the gate, generally speaking. So, we had all our gold positions and silver positions a couple of years ago. Right. So we're still extremely positive on that sector, but flowing downhill, the next sector that I think can do extremely well is copper. So copper is starting to break out right now. Fertilizer stocks are starting to break out in potash. So not just fertilizer stocks and potash necessarily, but agricultural in general have been in a bear market, but they're starting to. So I like these sectors that I think are going to do well over the next few years. But you don't want to sit on them necessarily for 3 or 4 years and have them do nothing, right? So you got to see technically when they're breaking out. Copper is, and the fertilizers are. Now let's go back in time. I think 5-6 years ago, I was extremely positive on uranium stocks, and everybody thought it was crazy. And why are you doing that? And the more people said I was crazy, and the more people that questioned me, the more positive I was. Because unfortunately, the more you hear about an individual sector and how great it is, the less mathematically your opportunity for upside is.
What was your thesis?
More positivity is factored in.
What was your thesis on uranium? Because for those who remember what it was like when the sector was dead, it was kind of post the Fukushima disaster in Japan in 2011. Everyone's turning off their reactors. And 5-6 years ago was before everyone's talking about AI. And so why did you think, was it just your simple attitude that you like to be contrarian and mean reversion? Did you have a crystal ball that was working better than ours?
Sure. I knew that people were anti-oil and gas at that time. And there was and wind and solar and all this cannot provide the baseload power that we need, right? It can provide on the margins, which is fine, but not the baseload power because storage capacities, et cetera. So nuclear was 20% of baseload power in the U.S. And uranium in particular, the average price of uranium was about $16 or $18 a pound at that time. And I knew that companies would not reinvest to find more uranium until it was at least $60 a pound. And a lot of the companies were $30 to $50 a pound for their cost. Absolutely love that. From a contrarian perspective, when the cost of production is 16, so every pound that you're producing, you're losing money on. That's phenomenal because that's not going to happen for very long. Either the entire sector is going to go bankrupt and nobody's going to produce uranium anymore, or the price has got to go up. And that's exactly what happened. The price went up from 16 to over 100, which was a little too much baking, overbaked, and now it's come back down. But the positives were still there. But the stocks. So at the time, I bought Cameco for clients at $12 to $14. Now, kind of sat on it for a couple of years, and it didn't do anything. And that's where sizing is important. being a portfolio manager, sizing is really important. You got to size it so if you're wrong on it in the short run, it doesn't hurt you. But when you're right, it's good. And Cameco is hitting $100 right now. So everybody loves Cameco now. I don't like it as much as I like the ones that I think will do that in the next few years.
So copper and fertilizers and Nutrien has started to break out, to your point, but still has a long way to go but to make up where it was a couple of years ago. What are your preferred ways to play, both copper and fertilizers? Can you name drop?
Sure. Yeah, I like Nutrien because it's the biggest company. It's the most market dominant company, and it'll flow through to the juniors over time. But for now, stick with the market leader, stick with the best managed company and the best dividend, and that's what Nutrien has. The stock was trading down quite a bit. It's up this year nicely already, but again, these commodity stocks, when they move, they have these big moves. So I like Nutrien just because of their global nature. It's a Canadian domiciled company, etc. Copper. There's really not that many copper companies. It's interesting to invest in or pure copper companies. A lot of them have lots of different metals that they produce. But here in Canada, I like Capstone. Right, Capstone's a good company. It's a big company, which people don't realize. Diversified operations, lower risk jurisdictions that they're invested in. Their cost is, a couple bucks a pound, $2.50 a pound. So they're making some pretty good profits right now. And I think there's some great growth with Capstone going forward.
Another question we got in the mailbag, this one's around energy stocks. What are Bob's thoughts on ARC Resources? This one coming from Al on X. And ARC in recent years has done some pretty significant acquisitions. They bought 7 Generations, of course, a couple of years ago. They just bought $1 billion worth of assets, more than that, from Strathcona.
ARC's one of the best managed companies in the industry, and I think that's important in the commodity space. Good management will figure out ways in bear markets to preserve capital, not have a lot of leverage, and make sure they're going on the right path. And ARC is one of those companies. We like gas, right? Even over oil right now. I think gas is clean and people are going to migrate towards that sector. Gas has recently broken out, and I think the stocks will too. I just think ARC is probably one of the 3 best companies with exposure to that area. Again, because of management, because of growth, and they have a dividend that they're paying, which I think is important.
You talked about how much investors, institutional money managers hate the energy sector and they don't want to touch commodities if they do touch it. And if they are going to be in the energy sector, it's usually this one stock, which Ray has a question about. Does Canadian Natural Resources have growth potential over the next 5 years? I mean, that's probably one of the most often top pick energy stocks that we get on this show.
Right. CNQ is a core holding for us. I mean, and I think it's interesting, we'll use a lot of these managers for their insights into the market, for the rotation, for small caps, whatever, but stick with the big names. And CNQ, if you're going to hold them long term, CNQ is probably the biggest. We bought it in 2021 at 15 for clients. They still hold it to this day. Probably will add some more. Because it's so out of favor, but the company just continues to grow. So yes, is there growth? Great management team, fantastic management team, actually. They realize they have a depleting asset, right? Anything in the commodity space is. So they're masters of finding good assets. I don't know what it's going to be going forward, but finding good assets at good prices that are going to be accretive to them. And, very few companies do it like CNQ. So if you just hold a company like CNQ and buy it on the big dips when everybody kind of hates it, the management's going to come around. The dividends up around 5%. It's incredible for commodity companies. They don't usually have a dividend like that. But here we go in the commodity cycle, right? Just like Rothman's raising dividends, buying back stock, and diversifying their businesses.
It's interesting you talk about growing through acquisition or being well-timed in adding assets. And it seems like the hunt is on in the oil patch right now. A number of assets, a number of companies, Meg Energy, for example, is in play. Do you think that they participate in that consolidation, call it in the next year?
CNQ?
Yeah.
Yeah, I think so. I think so, but they're very selective as to how they're going to pick their assets, right? They're not going to overpay, and I don't think people have to worry about overpaying right now, right? During the last boom back to that peaked in 2014 for oil, there was a few companies in Canada here that were buying lots of businesses, but they were way overpaying, right? So I think good companies are going to pull back during those times, and they're going to take these opportunities to buy the good companies and CNQs there. I don't know what they're going to be doing in the next year, but I know that the management team will be astute in what they do.
Over the long term, CNQ has been a home run. It's an outperformer relative to the index, relative to energy stocks. But why has it lagged in the, call it, last year?
Energy stocks are very hated right now,
But
all energy stocks are.
CNQ in particular has even lagged the index.
Right. I think people have kind of looked at the company and like your viewer asked they've asked where's the growth going to be for CNQ, right? Where's the oil sand growth, et cetera. And I think because of that, there's been maybe not so much transparency on the growth side, but I do think that the management will find something to do. And I do like to take, and this is a good point you bring up, because I do like to take good managements that at any particular time seem like they've kind of lost their touch. I really like to invest in companies like that because, or good money managers. Smart people don't become not smart, and not smart people don't suddenly become smart. So a rule of thumb that I tend to use is when not so smart people seem to be the smartest. I know that's near the end of end of a bubble that's happening. And I think right now CNQ is kind of in that area. People said, oh yeah, in the past they've been smart, but it seems like going forward here they've lost their touch. That's when I like to invest with those people.
All right, we're going to take a quick break. Then we've got some mining questions on the other side of it. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit RaymondJames.ca today to discover how you can live a life well planned. All right, our next question is about Barrick Gold. What is holding back Barrick? How do we count the ways?
Used to be the market darling, right? And then they merged with Randgold years ago, and it's still tough. This is a big problem. It's happened with Newmont too, right? It's a big problem in the mining sector when these big companies become so big and they have so many jurisdictions. When something goes wrong with a big project, it's so hard to unwind, right? So Barrick's had a series of these issues that have happened, and I think what you have to do in the market is say, have all those issues been factored into the market already? Are things getting worse? If they're not getting worse, it's a good time to invest in the company. So Barrick obviously has been a big problem as far as its performance, even compared to other mining stocks, right? But the valuation now is kind of taking that into effect, right? The valuation is a lot lower than companies like Agnico, right? Or Lundin Gold, who are firing on all cylinders. So that's the key in the market is you have to say, what is the valuation the market is giving this company and is it justified? So, right, Barrick's had political problems, geopolitical issues in the countries that they've been in. They've had problems with their mines, right? There was over leverage, obviously, in the sector. So they're trying to diversify away some of the assets that they don't need, and that creates opportunities for some of the smaller companies. Which
and I think it seems like even diversifying away from gold, changing their name to because they've got interest in copper, changing their name from Barrick Gold to Barrick Mining. Does that, because you're so bullish on gold, does that dilute the attractiveness?
I don't think, maybe over the short term, but I think over the long run, I think if we're in a big commodity bull market here, gold's going to be out of the gate first, but then we're going to get some sustainability with copper, right, down the road, and with silver. I mean, we haven't talked a lot about silver, but silver's probably in a bull market, and I think silver is very related to copper, right? So if Barrick is positive on silver, then they're going to be positive on copper because silver is a byproduct of copper. There's not many places that just produce silver. Mostly it's copper, and then there's some silver byproduct that comes out of it. So I think Barrick diversifying kind of their portfolio over time is a good idea. People tend to forget that oil and gas companies used to be in the mining sector too, right? A lot of these good projects down in Arizona, you'll see them drilled in the 70s, a mining project by Exxon and by Chevron. You're like, what? What were these companies doing, right? Well, they're all in the mining business, right? So I think there's going to be overlap. And I think that could be a big theme too. Not only Barrick going into copper, but some of these big oil and gas companies going into uranium or going into mining. You're going to say, wow, how is that happening?
Our final question in the mailbag, or sorry, our second last question. Obviously, we know you're bullish on gold. So Mark has asked, is it time to take profits in gold? I imagine your answer is no. But given the run up that we've seen in gold, how much more upside? Like, do you traffic in price targets for bullion?
Got lots to say on that one. Sure, it's been a big run. Now, if a stock is up 200%, your chance for upside is 200% less than it was at the bottom, right? So obviously, gold stocks have had a big run, but the average investor has not participated. The allocation to gold and to gold stocks is at all-time lows. GDX, big ETF in the U.S., is hitting all-time lows for the number of shares outstanding. So every time GDX goes up and gold goes up, people redeem shares. That is not what happens at the end of a bull market, right? That's what happens because people have been so hit over the head for so long that as soon as they get their money back or as soon as they make a little bit of profit, they sell out. And that's the biggest mistake that people do because the down market was so bad that as soon as you get a little bit of profit or at least get your money back or lose less than you had lost before, you say, okay, I'm out. And I don't want to ever talk about that sector again. That's the stage we're in, and that's usually the beginning of a bull market. But I will say that there's a time to exit for sure. One of the strategists at Sprott, his name's Paul Wong. Years ago, he told me this, and I think it's important to mention his name because it really changed kind of my outlook about the cyclicality of the sector. And I said to Paul, I said, it's easy to be a contrarian. It's easy to just buy into the puking. And that's what I like to call it. Whenever I see a sector puking out, like silver stocks were in February of 2024, I'm a big buyer. I just buy and buy and buy and buy into that sector. But I said, that's great. But you have to exit these sectors once in a while. When do you exit the gold sector? The gold stocks, for example. And Paul told me, he said, well, at the bottom of a cycle, gold stocks are probably going to be 3 or 4% of the TSX. And he said that nobody's interested, nobody wants them, and that was the case a couple of years ago. They're about 10% right out of the TSX. He said at the top of the cycle, they might be 14 or 15% of the TSX. And he said the race will be on when they're 13 or 14% of the index. For generalist portfolio managers who missed most of the run, they'll be buying into the gold stocks. And he says you want to start scaling out of the gold stocks when your average generalist money manager has market weight in gold. The average generalist will never be overweight gold stocks. You can be assured of that. They won't be overweight, but they'll get up to market weight. And he said, once they get up to the market weight, you got to start saying, okay, where's the buying demand coming from in this perspective? That's why, again, I love oil and gas. It's 4% of the S&P 500 right now. In 1980, it was 20%. I'm not saying it's going back to 20, not at all. I mean, technology, we've had changes in the market, but 3 or 4%. I mean, what if it goes to 8%? right? That's very feasible. That's huge outperformance over other S&P stocks.
I love these insights. I want to squeeze in one more. Maybe we'll just do a couple seconds on it. A question about your favorite non-commodity name right now, because you said you don't have to be in commodities. You can be anywhere.
Mm-hmm. I would say probably Telus.
Ah.
We bought into Telus.
Speaking of puking.
Why is that? Well, there's three companies. They're all in kind of bad shape. Rogers, BCE, and Telus. Telus has some more growth ahead of it. They have a sustainable dividend, I think. Things have stopped getting worse, right? This all started back in 2022 with these companies because obviously the debt load, and when interest rates go up faster than they had in 100 years, that's going to hurt a company as it's trying to roll over the debt, same as it's hurting the US dollar right now as people look at the US having to roll over its debt with higher rates. So I think a lot of that's behind us. I think the valuation got low enough. The dividend is sustainable that things have stopped getting worse. And if they just get a little bit better, I think the stock could have a nice little run.
Okay, let's take a quick break, and it's time to get into your pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, in Bob's Pro Picks, he has brought 3 funds that invest in different sectors. So you're bullish on those sectors, but it also speaks to, Bob, what you've been mentioning about selecting the right managers. So these managers are Sprott, Dynamic, and 9Point. And we'll go through each of them, but just at a high level, how do you go about, stock selection is one thing. What's the secret sauce to money manager selection?
Sure. I did a book many years ago called Stock Market Superstars, and it was interviews with 12 of Canada's best money managers. Some of them are resource people, some weren't. Some were value managers, some were growth managers, and they all had different styles. And I tried to put my finger on the one or two things that made them way more successful than other money managers. So I think that's important because it's never anything they say. If you line up 10 money managers, they'll all say the same thing. You say, well, why are 2 of them great and the other 8 are mediocre? Well, there's something, the way they look at the world, past experiences, coming from poverty, understanding things that other people don't look at. And I think that's important. So we have a history of doing that. And I think in the as I mentioned, 80% of money managers aren't necessarily worth investing in, right? Because they're all, and it's not their fault. The consultants have told them to crowd around the benchmark, crowd around the index. And so, because if you stray from the index and you're wrong, you get fired. So they stray around the index, and then there's management fees, and you underperform the index. But there's 20% which have provided a tremendous amount of alpha and a tremendous amount of opportunity. And these are the people who look at the world differently. They aren't necessarily one style of money manager, but they stick to their style. They don't deviate, and the results show. And I think that's so important in the commodity space because, again, we've talked about it's a pretty tough space to invest in, right? It's not like you can buy and hold Apple for 20 years, right? Generally speaking, you've got to understand the cycle, and you've got to understand when to get out of it and when things change for a company.
So with that in mind, let's go to your first one. You've mentioned that you're bullish on silver, but we didn't get into it. And the way you express that is in the Sprott Silver Miners and Physical Silver ETF, which anyone can buy. The ticker is SLVR on the NASDAQ, and it's relatively new. It's only been around in 2025. It's done very well. Talk to me about both that combination of money manager plus your bullish view on silver.
Sure. Silver is kind of half a precious metal and half an industrial metal. So we're positive on the fact that on the precious metal side of it, obviously because of the U.S. debt load, et cetera. But also silver has had 4 years of its supply-demand deficit, right? So the supply hasn't increased, the demand is going up. And we saw that with palladium a few years ago, and then palladium prices absolutely skyrocketed, right? They went up tremendously because it catches up sooner or later. The other thing is the gold to silver ratio, right? Now, there's a lot of people that say it doesn't really matter, but what it tells you is kind of the psychology of the market and where the flows are going. So the gold to silver ratio recently was at 100 for a couple months. It's only been at 100. In other words, the price of gold, if gold's 3,000 and silver's 30, and that's 100, it's only been at those levels 3 times in the last 40 years, 50 years. And those are crisis times, right? It was during COVID, times like that. So we just went over 100 again. So that tells you that the relationship, when it narrows back to maybe 30 or 40 at the end of a bull market, silver has a lot more upside. Gold's had a huge run. People overlooked silver. Silver and gold are related to each other. They're both precious metals. We haven't seen a lot of investor demand, but silver is the best conductor of electricity, right? So you need tremendous amount of silver for solar panels. There's a big debate right now about solid state batteries that are coming out and how much silver is going to be required for those for electric vehicles. So I think on the demand side, we see silver doing very well from an industrial perspective, but also, you get substitution in commodities. So in other words, if gold becomes very, very expensive, people tend to say, well, how do I participate in the precious metal space? I'm going to invest in silver. And interesting enough, I was talking to somebody the other day, and in India, I think they have 5 million weddings a year, and they always give gold, right? That's the big deal that they give, which is a big source of demand, actually. I heard that recently there's not as much gold being given at weddings in India because the price has gone up. And they're giving platinum and they're giving silver.
Interesting.
And I think that's really important.
And this ETF has done really well. Silver's up 20% so far in 2025, and this ETF is up 43%. So already they're outperforming. Your second pick is a little bit more of a mixed bag in terms of the commodities that it holds. This is the Dynamic Active Mining Opportunities ETF, ticker DXMO, and that trades right on the TSX. Looking at their holdings, as I said, it's a grab bag of sort of gold stocks, copper stocks, uranium, a little bit more overweight, the gold stocks, and managed by Robert Cohen, who, of course, and Emily Griffiths, who are well known sort of in the commodity space. Is this more play on the manager than what they're investing in?
Well, Rob has produced a tremendous amount of alpha. I mean, it's been since 2011 when it peaked. I mean, the gold sector has generally been a pretty horrible sector. And when you look at GDXJ, which is kind of the comparable to him, GDXJ peaked at 160 in 2011 and it's 70 today. So that shows you the benchmark. Meanwhile, Rob has averaged almost 20% a year since that time, which is incredible alpha in a horrible sector. To have that sort of alpha has been absolutely incredible. So that was the precious metal side, and I've known Rob for many years. And him and I had a chat, a few years ago, and I said, Rob, I mean, you're such a great stock picker on the precious metal side. Why don't you do something where you can choose copper stocks, or uranium stocks, or whatever the case is, because you're such a great stock picker. And that's why, not because of me, but this product came out, and that's why I'm so positive on it. Because gold is cyclical. You're going to have times where it does very well, very poorly. But, Rob's a bull on uranium, and you see uranium stocks in there. You see the best copper stocks, the best uranium stocks. He has a knack for picking stocks that actually become mines. And one of the reasons is because he's a metallurgist, and he can look at the metal and say, is this going to become a mine or not? And I think that's his kind of secret sauce that a lot of other managers don't have. And it's small. Right, you need something that's very small in the mining sector. Once you get up to billions of dollars, you can't make your alpha that you used to make. So that's what I love about the product here, is that it's diversified in mining. There's going to be lots of places that he's going to find opportunity as the cycle progresses. But you have one of the best stock pickers in the sector too, in a really small portfolio.
And just for reference, that GDXJ that you're referencing is the benchmark. That's kind of the junior mining index. And so to be able to outperform that's no small feat, because that index can be a bit of a heartbreaker. Okay, your last pick is of a fund that many people will know the money manager of, the 9 Point Energy Fund. Eric Nuttall is the manager. He's been on this show twice, and he's got something of a cult following. And to your point about liking gas over oil equities, that's something that Nuttall spoke about the last time he was on the podcast in April. Right.
And he's been heavier in the natural gas side. He has a relatively high turnover. But I think, in the oil and gas space, it's kind of like the mining space. You really have to know somebody that knows the small cap names, can go large cap, can go small cap, can go mid cap, can go US, can go Canada. And I think that's important to give a manager all the tools that necessary. Because if you say, oh, you're going to be a manager that's going to be a large cap Canadian oil and gas manager, well, they're not going to be able to perform as well as being able to dig down and look at relative valuations, et cetera. So Eric's proved himself over time to do a very good job. It's lumpy. It's always lumpy, the returns. But if you take a manager like him and say, hey, wow, things haven't worked out too well for the last couple of years, for example. I mean, he's done well, but if you can find periods of underperformance with a great manager like that, it's time to invest because it's going to come back. These stealth bull markets, and again, what I mean by that is people don't realize that we're in a bull market, but we are. When we get into a bull market and everybody knows we're in a bull market for something, the chances of gains are very low at that time. That's why I'm positive on right now. I don't think anybody would argue we're in a really strong bull market right now for oil and gas. That's why I like it right now. All right. And the fund has actually done pretty well in 2025, outperforming oil and the TSX oil producers. Bob, I think you convinced me to get interested in commodities more than anybody else on the show. So I appreciate your time. Thank you so much for joining me. Fantastic, Amber. I really enjoyed it. And make sure you stick with us this week. It is Commodities Week. It is Stampede Week at In the Money. And our next episode is going to feature none other than Adam Waterous. And he has been extremely active in consolidating in the oil patch. And, he's pretty hopeful that he'll continue to do that. I'll get to sit down with him live at ATB. So if you have any questions, send them in, questions@inthemoneypod.com. Other than, are you going to pay more for Meg? Don't worry. I'm going to ask that one. Or you can find us anywhere social media @InTheMoneyPod, and we'll catch you on the next episode.